So what is a management buyout, an MBO? Well, it is an exit strategy for business owners. To define it, a management buyout is the acquisition of a business by its core management team, usually in coordination with an external party, such as a credited lender or a private equity firm. By leveraging the existing experience and knowledge of management, the MBO is a viable option for owners to monetize their ownership while ensuring stability within the firm post-sale. Now, this is an option usually for private market companies where owners are looking to really focus on not only monetizing their ownership so that they can liquidate their shares and, focus on retiring or, passing down that money to, their grandchildren, but at the same time, they care about the future of that business and hopefully see it continue into the future. And so the best way to ensure that that business will survive through this transition is to really give it to the people who helped you build it, the management team. And so through a management buyout agreement, you're ensuring that that business is going to perform well in the future. And studies have shown that value is created through an MBO. The MBO is different from a management buy-in, an MBI, where an outside manager or executive team purchases a majority stake in a target company and replaces existing management. Now, there are also other options that are spoken in the same conversation as an MBO. There's the management buy-in and buyout, and this is where an existing management team is combined with an outside management team to purchase the target business or company. There's also the institutional buyout, the IBO, and this is where private equity institutions and other venture capital firms bid for 100% of the equity of the target with a view to bring in management after the deal is completed. And there's also the leverage buyout, the LBO, the most common, and this is where debt is used as part of the acquisition price to leverage the equity holdings and increase the return to shareholders. Now, for anyone who knows something about private equity and leverage buyouts, then the management buyout transaction is relatively simple to understand, simply that management is the one that's leading that transaction versus the private equity firm, which approaches a entity in a scenario where it's an LBO. So that's really the big difference. So why pursue an MBO? Well, the motivation of an MBO stems from the owner who has a desire to retire and either sell the whole business or a controlling stake in the entity. Although being fairly compensated is a priority to sell that business, the independence and culture of the business is very important post-sale. Now, the main advantages for the owner are that it provides a controlled exit which can occur over many years, providing flexibility. So an MBO transaction doesn't have to be completed right away. The owner can raise up the topic a few years before and talk about, are you guys interested in this? Well, let's start planning it. Let's start preparing for that transition. Also, value is maintained through the continuity of the business. The transaction involves no outside party, and that's a very important part, because when you think about it, there's a big risk if you open up your business during the due diligence phase of the transaction. If a competitor is going to bid for your company, they're seeing all that inside information, right? But with an MBO, there's no outside party. There's the financial backer, which provides the financing, but management is the one who's really taking charge of that business, and they already know it. So not only that, but it also rewards the team that built that business and incentivizes them, because now they have a piece of equity in the business and want to grow that value, want to grow the business's value in order to help the business grow and for them to become richer. So really the transaction is beneficial when you look at the business as a whole and the group as a whole. Now the downside, it really is the lack of employee liquidity, which limits the sale price. So for the seller, if the seller is only interested in maximizing the total value of that sale, it's better to just pursue an auction process rather than a management buyout, because the majority of the time you're senior executives. So it's not only the CEO, but the COO and the CFO, and maybe even senior vice presidents. If they participate in this transaction, they're not multimillionaires. They will struggle to really finance the full equity portion. So what ends up happening is that they help fund the deal with financial backers and a lot of leverage. Now, another big disadvantage is that after the MBO, it changes the relationship from an employee to an owner perspective to business partners. So now the owner has to, if they remain with the company, so they still hold a little bit of interest, then they will have to work alongside his business partners rather than the people that used to report to him. And that can be a challenge. At the same time, the business's assets will likely need to serve as collateral, which in a really bad recession could really impact the company, because if they do go into default and into bankruptcy, then the company loses all of its assets, and that can really destroy the entire company. And at the same time, you are now negotiating with people who work for the owner, right? So if I'm interested in selling my business, I'm sitting across the table from people that, I've known my entire career, or that are my friends, right? And so when I'm negotiating with that, there's a risk of tension, because for me, I'm trying to get an appropriate price for my business. And for the management team that wants to buy in, the thing is, they don't want to pay too high of a price, because then they will never meet the expected returns for their financial backers. So there's a conflict, a high price versus a low price. One party supports one side and the other party supports the other. So there needs to be a balance found in between, which again takes time, and majority of the time there's tension involved. Now, let's take a look at the stakeholders of a successful MBO transaction. Now, the common ones are the private equity firm or the financial backer, the management team itself that's taking over the business as owners, the owner, the vendor that is selling that entity, and the business itself and its financial and business characteristics. So the owner. Now, the owner has value expectations that need to be considered seriously. So if I'm the management team approaching the owner and asking him, can you sell it at X dollars? I need to be aware that this individual probably committed his entire career to building up this business. And so I need to show a lot of respect and a lot of analysis when it comes to valuing his business. And so that requires advisory services, contacting an investment bank and other advisors who can provide that valuation in order for you to approach that owner and show him, hey, this is how much they value your business at. This is how much I feel I can reasonably offer you based on the financing I have available. And hopefully the owner will be receptive to that. Now, in addition, the owner can actually play a part in the financing of that deal, so that he can help structure a vendor take-back kind of loan, a VTB loan, where really, if you can't really meet the full asking price that he wants, what can happen is that it's similar to in the real estate market, where you can go to the existing homeowner and say, hey, you know what, instead of me going to the bank and picking up a mortgage, how about you set up, a private mortgage between us two, so that I make monthly or annual installments and help pay down the price that I initially promised. And so that can also be provided here. As long as the two parties agree to it, it's all legal. And at the same time, that owner can provide additional assistance in ensuring a fair transaction. At the end of the day, if the owner is really interested in an MBO transaction, again, he cares about the future of that business. So he doesn't want to put the future management team in a position where they overpaid for the business, covering interest expenses so bad that they fail to reinvest in the business, and eventually shareholder value is destroyed. So the owner plays a very important part in a successful MBO transaction. Now, the management. Now, being familiar with the business allows management to accurately make projections and ensure a smooth transition. The financial commitment made by investing their own equity results in more aligned interests with backers. So the true core benefit of an MBO is that the management team believes that if they become owners in this business, they can add value by maximizing cash flows, and therefore, the discounted net present value of those cash flows will result in a higher valuation today. And at the same time, they want to become rich in the process, right? They know that they can improve this business, so they get invested in it by using their own equity, by using their own money. And by taking out that investment, really what happens is that by aligning the interests of the management team with the financial backers, you have a successful transaction. Now, majority of transactions are like that, but sometimes maybe the management team is excluded or some key individuals are excluded. So it's very important to make sure that you identify the key contributors to the organization and make sure that they are able to participate in that equity reward program. Now, further, employee stock ownership plans also incentivize other employees. So going lower down in the organization, maybe just senior vice presidents, directors, maybe even at the analyst level. If you want to participate in this transaction, we need all the help we can when it comes to financing the deal. So if you want to contribute some money, you can participate in this. And what that does is it really locks in that team. It locks in that group of people to really commit to getting that business from point A, which is today, to point B, where it's exiting that business, selling it by adding value, increasing revenues, increasing net profit, and overall selling it at a profit, and therefore, becoming richer in the process. So that's very important. Now, the business itself. Now, communicating the change in responsibilities to remaining employees is essential. So one of the things that needs to be done in a successful MBO transaction is that in the future, many of the existing managers will become much more senior or actual business owners. And with ownership comes egos. And with a lot of money that's on the line, people become protective. So it's very important to outline the key responsibilities of employees. At the same time, ensuring that the company protects cash flow and invests in organic growth helps increase shareholder value. So we talked about this with the management team. At the end of the day, it's the business that needs to grow in order for an MBO transaction to really work. You can really kind of find a very stable company and which will pay down its debt and eventually realize an internal rate of return. But the riches that come from an MBO transaction are where you grow the business in the meantime while also paying down debt. So your equity portion actually increases significantly in value. And at the same time, you want to continue to enforce strict procedures, which will help in the future exit of the company, as it sets a very structured and formal process to really kind of set up a successful business that some future buyer would want to purchase. And then probably the most important stakeholder when it comes from an outside perspective is the private equity company or the financial backer. And although mostly private equity firms, the financial backer invests alongside the management team to buy out the vendor's shares. So they play an essential role in financing the deal. However, if the company has previous experience in the sector, future growth acquisitions can be beneficial and can be sourced through that company. So one of the benefits, and this anyone who again knows LBO transactions, who understands private equity, one of the ways the private equity firm can really maximize the internal rate of return is by making an additional acquisition and adding it to that company. So realizing synergistic benefits and at the same time, expanding the product line in order to, grow the company and therefore maximize its value. With those connections, in addition, if those private equity investors who used to be investment bankers or worked in the capital market space, they have existing relationships with investment banks and traditional banks. So when it comes to accessing future capital, that is also expedited because now you have someone who's interested in seeing your business succeed, and they will help you really connect with those people who can offer you capital. So private equity financial backers play an important role in this. So what about the deal financing itself? Well, from a consideration perspective, this illustration is relatively confusing, but I can split it again, focus on the three phrases. So first one is the negotiating value. So when you're financing a deal, you want to make sure that from the management's perspective, you're trying to get the lowest price possible. You don't want to overpay for that business. At the same time, you want to recognize that a proper capital structure. You don't want to over leverage where you're financing, 99% debt and 1% equity. And at the same time, the financing process within that capital structure, essentially it means, are you just going with bank debt, which has low interest rates? Are you going only with junk bonds, which has high interest rates? There's a trade-off to the two. Lower interest rates, but at the same time stricter covenants versus higher interest rates, but looser covenants, right? Maybe there's some mezzanine debt in there, which can really help you. So it depends really on the certain situation, but at the end of the day, you really want to make sure that you're considering the capital structure. And this is why, again, a financial advisor is essential to this process. And so here we can kind of see the risk and reward. So the rate of return is highest on the equity side, whereas senior debt is lowest because it has the lowest interest rate. And as you go higher in seniority, the risk declines, and therefore the rate of return on that respective debt or equity declines, right? So although equity provides a lot of upside, at the same time it provides a lot of downside and has a lot of risk, whereas senior secured debt is much more protected. In the case of bankruptcy, those bondholders are probably going to get their money back, right? So again, it depends on how you want to pitch that deal and structure that deal. So the financing structure is essential to the success of the MBO transaction. The sources of financing can kind of be split into the debt, which is the senior bank debt or high yield junk bonds, the mezzanine debt, which is a hybrid of equity and debt. And I've already made a video on this, so I do recommend that you check out my channel on that. It's very, very cool. And the cool thing about this is from the equity holder's perspective, mezzanine debt is viewed as debt. But from the debt perspective, from the debtor's perspective, mezzanine debt is actually seen as equity because it's lower in the seniority structure of that company. And therefore, these bondholders view their claims as more senior and therefore more protected than the mezzanine debt holders, which have both warrants and very high yield debt. So they recognize the mezzanine debt as more equity. And so if you're going to go to a bank, say for example, you have 30% equity, 10% mezzanine debt, and the remaining percent, 60% senior secured debt. Well, the thing is, from the bank's perspective, you actually are financing the deal 40%. Your 30 plus your 10% mezzanine. And so that's really important to understand. So it is an excellent way to really bridge the financing gap between senior secured claims and very unsecured risky equity shares. And then also vendor finance. So vendor finance is another important thing. So with debt, there's a senior debt, high yield debt, as we talked about, but with vendor finance, and we talked about this before with how owners can play an important role in the transaction, an owner can also look at that management team and say, you know what, like I want fixed installments. So the seller agrees to receive installments on a yearly basis to pay down the remaining portion of the the transaction. So say for example, the cost of business is going to be $20 million. We came up with about $15 million. The remaining $5 million can be a vendor take back loan in which we pay down the loan in 10 years. Right, and so we pay down that remaining $5 million in equal installments across a 10-year period. Right, so that's another way to really kind of help finance the deal. Now, the management team must fully understand the restrictions and requirements of the deal structure. Cash flow is essential to the deal. If the business generates cash, management must determine what would be a realistic bottom in order to determine their threshold for debt. So the big takeaway from this slide is that for the management team, they have to really determine and ask themselves, in worst case scenario, in like the bottom of a recession, if the company were to perform incredibly poorly, what cash can we really kind of put aside to meet our interest expense? What's really like the bottom of the bottom? And so you look at that interest expense and that's your threshold. And you're like, okay, like if we were to really fund and take all our remaining gross profit and put it all towards interest expense, what is that threshold? And so that's really what you want to take away. With integrating mezzanine debt, though, and this is one of the benefits, you can take PIKE loans, which are paid-in-kind loans. And essentially, instead of paying the interest expense when it should be due in that period, you can convert that existing interest expense liability into another loan, which can be added to the ending period or the principal repayment period. So say, for example, you have $1 million loan and you have an interest expense 2 years before you pay back the initial principal of $1,000. Well, you can convert that into PIKE, paid in kind, and that means that instead of paying back $1 million at the end of the 2 years, you're paying $1 million and $1,000. Okay, so that's kind of what a PIKE loan does. And so these were abused back in the 1980s, but they're still used now in mezzanine debt financing. So now let's look at kind of a classic pre versus post MBO transaction equity structure. So it's very simple. In the pre, you have the vendor itself, like the owner of the business, and the CEO, who of course is incentivized to own a little bit of equity in order for him to work in that role, right? And so pre-MBO, the vendor owns majority of the business, of course, because they're the owner of that business, and then the CEO who works for the vendor owns a little portion of the business. Now, post MBO, what happens is the CEO's equity. He's usually the leader of that conversation. He's usually the one who raises up that topic with the other management team, and so he most likely will benefit the most from an MBO transaction, right? So the equity portion for the CEO expands. The vendor is paid off in full. Now, the private equity sponsor covers a big portion of that, and then at the same time, a little bit of that equity is now allocated to other management as well to really align the interests of the senior executives with the ultimate goal of really maximizing the company and providing an excellent exit opportunity for their private equity sponsor. So this is kind of a classic pre versus post MBO transaction equity structure. Now, what about the incentives? Now, when we talk about the shareholders agreement, in coordination with financial backers, a shareholder agreement is approved before the transaction is completed to ensure that management direction and authority is clear. Now, the shareholders agreement essentially is a contract in the private market space where the owners of that business, with their financial backers, in this case with the MBO transaction, sit down and they kind of outline who has what, who's responsible for what. And in certain scenarios, if someone wants to exit the business, how do we value those shares? We deal with all the bad cases. You have to really be upfront about that. You have to be open and account for these things. And one of the things that you also have to account for are incentives, performance incentives, because that's a big thing from the financial sponsor's perspective. So there are usually kind of 4 common incentives that are included in the shareholders agreement. Now, of course, we know what bonus schemes are. Essentially, you receive higher and higher bonuses based on the performance of the company. But sweet equity, options, and ratchets are 3 common incentives in the shareholders agreement during the MBO transaction. So sweet equity is where managers pay a lower subscription price for their initial equity stake and therefore make a higher profit than the institutional shareholders when the shares are sold. So they buy in at their amount of equity at a lower price than other people. With options, it gives management the option to buy further shares in the business at a below market price when the business is sold. This incentivizes them to create value and stay until this change of ownership occurs. And so essentially it's a call option where management has the option to buy more shares in that business to increase their equity portion if the business is sold. And majority of these conditions, majority of these incentives are executed at that exit, really to keep management in place, to keep them really increasing the value of the business over the medium term rather than just the short term to boost up the valuation and then just leave, right? So you want to make sure that as a financial sponsor, you're keeping them and focusing on medium to long-term growth. And then also ratchets, and this is very specific to the MBO. So ratchets allow the management team to ratchet up its percentage shareholding in the company, depending on its success. The ratchet is primarily based on the return achieved by the institutional investor on its investment, which is referred to as the internal rate of return, IRR. Now, this is usually measured on an exit. Commonly, a mechanism can be used where the managers receive an amount of additional equity for each percentage point that the IRR reaches over a set figure at the date of the exit. And so essentially with ratchets, at the exit of the company, when the financial sponsor sells their equity, if that equity achieves a return minimum threshold of 20%, great, you met their target. But if you were to sell it at 25% internal rate of return, that extra 5% results in an increase in the equity portion resulting from the management's perspective. So that's a very important incentive that's often included in agreements between the financial sponsor and the management team and the MBO. Now, the question when you're looking at a business is the business suitable for an MBO transaction? And really, MBO candidates are very similar to LBO targets because at the end of the day, there's a lot of leverage. You're focusing on cash flow, paying down debt, growing cash flow in order to grow the overall valuation of that business, and then exiting the business from the financial sponsor's perspective. So really, you're focusing, is that business generate strong cash flow? Does it generate strong cash flow? Does it have a leading and defensible market position in order to protect that cash flow in the future? Does it have growth opportunities to expand that cash flow and expand revenues and therefore expand its value? Does it have efficiency enhancement opportunities which the management team can take advantage of, cut costs or, change the product mix in order to leverage the valuation of that company? Low capex requirements are beneficial because that means that less cash is paid out to kind of support the existing asset base of the company. And at the same time, if that company has a strong asset base, then the cost of debt is significantly lower because it can be used as collateral. And therefore, that reduces the amount of cash outflow from quarter to quarter, which is beneficial because then it increases the internal rate of return for both the management team and the financial sponsor. So comparing the two, if you were to sell to a third party through an auction or a targeted auction or a negotiated sale, selling to a third party usually results in a higher bid or a higher price. But with an MBO, there are other added benefits. So let's compare the two. When you're selling to a third party, a higher price is usually realized. The certainty of the purchaser financing is much more likely. So the purchaser, either a strategic or financial sponsor, probably has that financing versus the management team, which usually struggles to find that financing. There's more warranties awarded to the purchaser, which essentially means that there's more conditions in that contract. There is a longer transaction timeline. Essentially, to sell the business, it takes a much longer time. And at the same time, there is a higher likelihood for information leakage. When you're opening up the business to third parties, whether financial or strategic buyers, there's a risk that those buyers are not going to, keep in line with their confidentiality agreement and kind of start talking to other competitors and other companies about, oh, I saw that they had this, and that growth, right? And that results in information leakage, which can be quite threatening from a valuation perspective. Now, with the MBO, the management team usually understands the business, which provides a lot of increased speed during due diligence and at the same time with the familiarity of that transaction. The problem, though, is management lacks liquidity, as I said. And so that's a big challenge that, the owner really has to ask themselves when they bring up that issue. If I do bring up this issue, do I really think that these guys and girls can really find the financing to acquire my business? If the case is no, then it's better to just sell out to the third party and get the highest bid. At the same time, the vendor is less willing to give warranties. So in this case, because the vendor is very familiar with the individuals acquiring the business, he's looking for a much more realistic and fair transaction, so there are much less conditions in the contract. There's less due diligence required because the management team is familiar with the business, and the transaction remains in-house and usually results in a faster timeline, which is beneficial to ensuring the completion of that transaction. Now, what about mistakes in the MBO process? There are many mistakes that managers make throughout the MBO process. This is a highly leveraged and a liquid long-term investment, and being proactive is essential to ensuring post-transaction success. Now, there are many mistakes. There are some great articles out there. I've linked some articles in the video description for you to read with regards to mistakes and also reports with regards to just the general MBO transaction. But kind of 5 important mistakes that I really want to talk about and highlight in the video are here. So let's go through each of the 5. So mistake number 1 is leadership mistakes. So consider this. Post MBO, as a senior executive in the firm, which one do you prioritize first? Being the owner of that business or being the employee? Now, this is a difficult question because most believe that being the owner means that they can sit back and enjoy the dividends of their labor. This isn't the case, however, most times. With an MBO transaction, what really results is that the management team is put in a position where they're expected to perform very, very highly. They're expected to perform at a high level to realize growth and to realize expansion in the cash flow. And that means that really you are an employee first and then an owner. So when you think about the transaction, majority of the time when the management team looks at the potential to get rich through an MBO, well, great. In the long term, because it's an lucrative long-term investment, in the long term, yes, if things do go well, you can become very wealthy. But in the short term, you are playing a key role. You are leading the role of expanding that business and realizing the value that you projected. So really, you're an employee first. You're still working for that company, working to grow that company. And then in the future, once you exit that business, or if you want to kind of monetize a little bit of your interest, you then become really the owner where you can kind of sit back and let others do the work. So that's a big mistake. Another one is getting greedy. Now, this seems like a relatively easy mistake to avoid, but in the middle of a deal, when there's deal fever, it is often ignored. When structuring the financing of the deal, leveraging the company to the max with low-costing bank debt is the best way to maximize equity returns, but it also limits the business. We talked about this in the equity financing side. So essentially with bank debt. Bank debt has lower interest payments because it's much more senior and therefore much safer. But at the same time, they have much stricter covenants because they want to protect that investment. So with those stricter covenants, it might be very difficult to really kind of prevent the bank from calling you up when that cash flow begins to fluctuate. With high yield debt, yes, in the short term, the cost of that high yield debt is much higher, but there's looser covenants, and therefore, if things kind of hit the fan, or if the economy begins to slow down and cash flow begins to kind of decline, and your financial metrics begin to change, well, what really happens is that you can kind of still wait it out, because with high yield investors, they're comfortable with that risk level. So this is, there's some important questions that you need to ask when you are financing that deal. Now, with the shareholder agreement, the mistake is usually that a lot of people just kind of skim through it. They don't spend a lot of time. With differing equity interests in starting positions, management in an MBO needs to clearly define the post-transaction roles and responsibilities. In addition, a central leader needs to have much more authority over the decision-making process in order to ensure stability. A lot of the time with egos and dangerous leverage, where people have invested majority of their net worth into this MBO transaction, emotions can run high, and if a legal agreement is not in place, shareholder value can be destroyed when disputes do arise, because all of a sudden it's like, hey, we don't really have a set way to kind of resolve this problem, so we're just going to yell at each other for weeks on end, which disrupts business and in the end destroys value. And so it's very important to really set standards and procedures for dealing with problems based on, the existing decision-making process and the existing holders of that business. Now, making the tough decisions. This is another difficult, but very often is a big mistake. Now, post-MBO, the company can look very different, and management needs to realize that as owners of the business, their relationship with colleagues needs to change. This growing up phase results in a lot of hesitation when it comes to strategic moves. If the company needs to cut costs to cover interest expense, management might need to fire their own friends in order to protect their own investment interests. They have a fiduciary duty to act in the interests of their investors and financial backers in order to protect their investments. And with their own money on the line, there are difficult cases where the management team hit a rough patch. They need to cut some costs, they need to fire some friends, and they won't do it because they're too afraid. If they do that, if they do kind of back away and hesitate, what ends up happening is that everyone loses rather than just one side losing. And that's a very big mistake. In addition, and this is just the most ignorant, is forgetting about the business. So one of the most important questions and frequent questions is, why are investment bankers and advisors paid so much? Well, it's the value that they add during that process. Because during the MBO transaction, the business still needs to be run. So management must remember to continue focusing on the business and not only on the exhaustive negotiation process. By hiring capable advisors, majority of the deal-related responsibilities can be outsourced, which ensures management can pay attention to the business and their new relationship with financial backers. And so this is very common. Majority of the time, management's in that deal fever. They want to be at that table where they're negotiating. But if you have a capable investment bank who's representing you, you are paying that investment bank to do that. So just let them handle that while you become familiar with the deal, but at the same time, you're still running the business. Because majority of the time what happens is there's, the culture suffers. There's rumors and concerns about, are we going to lose our jobs, and how are things going to change? So management needs to have a presence within the operations throughout that deal. And majority of the time they don't. Okay? That's pretty much it. This is a relatively helpful video. I enjoyed learning about this, the management buyout. There are other ways, many other exit strategies that I'll be covering on my channel. So I do recommend that you subscribe to the channel if you found this video helpful. If you do have any questions, please do comment below. I'll be sure to get back to you as soon as possible. And I do recommend that you watch other videos on my channel. I have some investment banking, valuation, interview questions for investment banking and equity research. I have tons and tons of videos. So I do recommend that you check out my channel, and hopefully if you find it helpful, you can subscribe. Have a great day, guys. Thank you.